Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Tuesday, May 2nd, 2023. Great having you with me here today. Today, we're going to talk about JOLTS. Remember, this is a March reading. We're going to get the employment numbers, ADP tomorrow, and on Friday, we're going to get them both for April. We're going to look back to March a little bit and see what's happening in the economy. At that time, we're seeing job openings falling 9.6. It is a meaningful, a meaningful decline from December. So we've seen that going the wrong way. What does that mean? That means that probably some weakness in the labor market wouldn't be too surprising given what we've seen. Earnings have been down, not down as much as people expect. Banking issues, and we're seeing the debt ceiling distort the fixed income market, particularly on the short end of the curve. And so not too surprising to see that. We see quits staying at the same pace. I mean, we're not at the 4 million, we're 3.7, a little bit lower, but not a lot. Hiring is slowing down a little bit. So there, still the numbers are consistent and not showing significant weakness. One thing it's worth knowing, we're seeing business services doing pretty well in the hiring column. What is that telling us? Business services is a kind of a catch-all, but it's more management related. That would be telling you that there are higher paying jobs in the economy being added, and that was going to actually help probably overall personal income as we move forward. And that has a tendency to look to spending. The job engine has been strong, not surprising to see it starting to run out of gas. And that's probably pretty normal at this part of the cycle. We've had a huge increase in employment. We're now significantly higher than the pre-pandemic levels. We've had wages moving up, and it's this mismatch between skills and opportunities that are still going to permeate in this economy. So, and the reallocation that goes on, these reallocations among industries are not very surprising. They can be a little bit painful because of different skill sets. For example, we should see a wave of people in financial services looking for jobs. Financial services has not been a hugely driving column in the economy. Particularly lately, we've seen medical, the ambulatory, and education be that area. After the pandemic, we saw retail, leisure being the strong drivers. So, yes, we see allocation changes, we see ebbs and flows within the labor market, and they can be challenging. Why? Because of the structural elements of unemployment. Structural unemployment comes from not having the right skills. It takes a long time to retool the workforce. It's one of the issues we're probably facing with the elder population. Over 55-year-olds don't have technical skills that employers are looking for in the job market, and therefore they're passing these people over. We have to remember that employment shifts, it ebbs and flows, and sometimes not as straight line as we would like it. So jobs are available, still a healthy number, still a number over the unemployment area. And if you anecdotally go to a fair amount of businesses, you'll see lots of help wanted signs. That tells us that the jobs, which is a key part of the expansion, continue to be strong. Yes, weakening, yes, a little less openings, but the whole pistons of the drivers continue to ease along. That does not say by the end of the year, we'll probably see some weakness, and it could be quite catastrophic in an element that it's having so much plentiful jobs and then falling away could happen quickly. But I don't think there is a real driver out there right now for firms to let people go. And so it may be on the additional side more than the letting massive layoffs, similar to inventories. Inventories are pretty lean. Inventories is what gets us into trouble in recessions. We have to, slow down so we can match and then not take the loss. Probably not going to happen this time. Employment, probably not going to see massive waves of unemployment, I should say. So we should sort of not throw the baby out with the bathwater and keep ourselves focused on the economy ahead. A little trying these days as the debt ceiling issues permeate, but net, we do think that will ease as the end of the month comes. There's a lot of little different ways out of the box right now. The Fed could be involved. We could also see, just a suspension for a week or two. So there's a lot of variables going on out there. And I think the trajectory, even though it's waning, is pretty strong. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.